Hello there, welcome. It's that time again for another weekly journey to the world of business across sub-Saharan Africa. You're watching Africa Business Weekly. Now, let's run you through some of the most impactful business stories this week. I'm David Alabi. From the withdrawal of subsidies for maize in East Africa to finding out the development priorities of the United States in West Africa, we'll start this week's journey from South Africa, and Peleza takes us through the business headlines in Southern Africa.
Thanks, David. These are the latest stories moving Pan-African markets right here from our South African studio. We begin with a small insert from last week's annual meetings of the World Bank and the International Monetary Fund. African finance ministers are calling for greater international support as the continent grapples with accelerating inflation because of the ongoing Russia-Ukraine conflict. Let's listen in for more.
We are expecting a slowdown in the global economy. Largely also or partly driven by the hard monetary policy that we're seeing, tightening of monetary policy that we're seeing across the globe without exception in dealing with the specter of inflation that we see across the world. Every other central bank is raising interest rates to deal with inflation and constrain demand. But for us in Africa, basically the inflation is rearing its ugly head again. And in my country, there's no exception in Zimbabwe. So the inflation is coming through various channels, through the fuel channel, through the food channel, and the fertilizer channel. On the fuel channel, we've seen the oil price and the subsequent fuel prices going up. And our countries have had to do a few things using stabilization funds to control the increase in fuel prices. In my country, for example, we've been using the strategic tax levy on fuel to moderate those prices. On food inflation, again, some countries in Africa have seen droughts, especially in East Africa. In Zimbabwe, for example, in Southern Africa, we've done rather better on food, but at the same time, food prices have remained high. So when we've had to institute measures to protect the vulnerable by distributing food to those who are vulnerable, and we'll be doing that over the next 6 months. So it's been tough, and it's going to get tougher. That's the message we're getting globally.
The current Russian-Ukraine war has indeed increased food insecurity in our countries. And already, even before this war, some countries in Africa, my country included, were already food insecure. And this situation have really unveiled the challenges that we have in our countries, and in particular, the issues relating to limited physical space that we have. So it has been very, very difficult for some of our countries to respond to these new developments, and a situation of increased food insecurity in the continent, in South Sudan, has increased immensely. Resolving these issues and these challenges definitely will require external support. It will require us to readjust our priorities, but mainly for the immediate term at least, in South Sudan, there will be a need for both humanitarian assistance, and at the same time, we would need concessional financing to address these shocks.
I think what we also came with was the attitude that, yes, there are problems, but we need to find ways of resolving those problems so that we come out of the crisis as quickly as possible. The issues of the debt, it is something that Zambia has been pushing hard on, and I'm sure later on we shall talk about that.
Still on this week's Economic Snapshot, we also spoke to the Deputy Director for the IMF African Department, Catherine Patillo, about the fund's latest regional outlook report. It expects growth to slow to 3.6% this year and 3.7% in 2023. CNBC Africa's Godfrey Mutizwa carried that conversation. Here's more on that.
So countries need to, make sure that they keep inflation under control. We've got to make sure that it's nipped in the bud, because in our region, then, again, the the most vulnerable, the poorest people are those who can't really defend themselves against high prices. And so our message is, countries should be gradually, cautiously, but not being complacent then about addressing inflation, particularly because there can be second round effects then, that even if it starts with external price drivers, that can feed into core inflation, and inflation then can accelerate further. So central banks need to watch very carefully, be looking at developments, be agile, nimble, be data-driven, be forward-looking, and raise policy rates as needed. We have seen in the region already around 2/3 of the countries have raised policy rates, median about 150 to 200 basis points, but the pressures are still there. So you mentioned the trade-off. This is potentially costly with impacts on private credit and growth, and central banks will need to manage that. But it's important to keep the credibility that central banks have gained as making sure that there is a price stability. Again, the picture varies. There are a number of countries that then would need to think about tightening more decisively, faster. Those will be countries where the domestic demand pressures are higher, or where inflation is quite high, or countries then with flexible exchange rates where the pressures from declining capital flows then are particularly strong, or countries with very weak monetary policy credibility, and they would risk then inflation expectations getting de-anchored if they don't act more aggressively. So our message is, again, cautious, gradual, but not complacent, and making sure to decisively address the inflation risks at this point.
And that's it from me. It's back to you.
Thank you so much, Palesa. We now move over to East Africa. Tassie is standing by to take us through stories that shaped headlines in the East African region this week.
Hi, I'm Tessie Carvin, and from East Africa this week, data from the Uganda Securities Exchange reveals that 3 banking stock prices declined compared to the same period in 2021. Most of the market is lower than it was in 2021 as the global and local economic headwinds affect investments. Sydney Ampaire, corporate and institute trader at SBG Securities.
Year-to-date performance of the USE, it is in red. That's for a fact. It's been plummeting, just like any other exchange across the world. We are across the globe. However, as compared to the all African region, you do find that Uganda in particular is not doing as bad, as our neighboring countries. We have been able to maintain, I would say a stable rate as compared to our neighbors like in Kenya, who had elections, right? And that's really affected, the all share index. So you find that in Uganda, one of our blue chip companies, that is MTN Uganda, listed last year in December, early December, has been a very volatile counter. It has moved from prices of 165 to 190, 200 to 165, ranging up and down. And this has only been brought in about by the play of the retail sector. So the retail individuals are the ones that really affect the movement of the share price here in Uganda as per se.
Yeah, I mean, just you've touched on how volatile the MTN bourse has been. There was a lot of optimism when it began trading last year, actually, towards the end of 2021. I mean, was that short-lived? Was it mainly because of the gloom economic outlook?
Not really, not as per se. It's just that the actual retail investor didn't understand the opportunities brought about by investing in the equity space, right? I mean, this is someone you're telling that MTN has a dividend yield, that outcompetes our short-term bills, right? But then they really don't understand it from a perspective of rate of return, on the investment, right? They do believe that that dividends are quite small, than the actual amount that they had put in. So we still have a long way to go in terms of awareness, right? Trying to educate, the people that have benefits, right? To understand the investment, because in particular, these are people who believe that investing in MTN was a short-term kind of approach, that will bring you the returns within a year or two at tops. But it's not the case. This is a long-term investment, depending on the dividend yield as per that particular year, right? Then one is able to break even in, say, 5 to 6 years in particular, but they don't see it from that kind of point of view. They believe if I give you money in January, right, I should be able to break even by June, or July. So that is the investment climate that we have here in Uganda. So there's a lot of stigma going around, and we need to sensitize all that, and we need to debunk all the flaws, I'd say.
Yeah, I mean, just looking at the bank stocks in particular, comparing to 2021 period, even though we had the COVID-19 pandemic, even though most economies were rebounding in 2021, they still performed relatively better compared to this particular year. What are the main factors?
Banks in particular, we have 3 listed banks in Uganda. We have Bank of Baroda, right? That is a national bank in India. We have the DFCU Bank, that's a development bank here in Uganda. It is a rural bank. Then we also have Stanbic Bank, which is from South Africa, under the Standard Bank Group, as per se. So during these 2 years of COVID, the Central Bank of Uganda, or known as the Bank of Uganda, had instructed listed banks not to issue dividends during the years of COVID.
Also from the region, millers have scaled down purchasing maize amid a cash crisis in the wake of 4 billion shillings that the government owes them. The debt, according to the millers, has cut their working capital even as the cost of maize remains high amid diminishing demand for flour. We spoke to Gerald Masila, CEO of East Africa Grain Council.
As a membership organization, we exist to serve our members, to provide data and information for our members, to undertake policy advocacy so that the policy environment is supportive to the trade. We also do trade facilitation, linking the farmers and the producers, and we carry out capacity building. To your question, you would like me to recap a little bit on the maize situation, or the maize market in the region, and specifically in Kenya. And just to say, today being the 19th of October, we are now heading towards the harvest season. So we got the maize in the main producing areas of the South Rift and North Rift being basically physiologically ready, and it's now drying up. And so we expect the current harvest to start getting into the market from around end of November to most of December. And we expect the market to peak, the maize market to peak for the current production somewhere in mid-December up to January. And then it will fizzle down out by February. Much of what will have been harvested would have been dried and would have been already presented out in the market and sold. What we have experienced, though, currently is that we are seeing quite a lot of trade of maize in the green form, when it's still green and not yet dry. That is to say, when it's still in the form of a vegetable, because green maize is really not grain, but is a vegetable. And so we have seen, because of the shortage that had been there for a while, most of this year, considering that in the lower eastern and region, we did not get the short rains harvest. There was a total failure of the crop. And so we have had a deficit, really scarcity of the maize grain in the country for most of the year. And as a result, we've had even most households not having much stocks for themselves, even for consumption. And so we've seen a phenomena that has not been quite ordinary in the past, where the trade of the maize in green form is going on quite a lot, where farmers are harvesting out the maize in the cobs and selling it out as green maize for those who are going to roast and maybe cook with beans using the maize as green maize. And that we see will will significantly reduce the final quantity of dried maize that will be available in the market under a situation where even in this current year's crop, we had, because at the beginning of the season, we had a number of factors that were quite negative to us. One, we had a shortage of fertilizer. There wasn't just fertilizer available at the planting season in February, March of this year. And the fertilizer the little that was available was retailing at very, very high prices.
These are some of the unique stories from East Africa this week.
Thanks so much, Tessie. Now, from West Africa this week, the United States Trade Development Agency signed 3 grant agreements for feasibility studies for healthcare development in Nigeria this week. Now, in a first official visit to Nigeria since her appointment as director of the United States agency by U.S. President Joe Biden, and Ebong joined CNBC Africa's Kenneth Igbomo to explore ways to improve ties between the United States and Nigeria.
Our priorities are very broad in general, but with respect to Nigeria, I'm here to do 3 things in particular. Connect with our partners, to assess the progress of our ongoing portfolio, and to further our engagement so that we can continue to support Nigeria's infrastructure development. With respect to the agency and our priorities, I should first maybe start briefly with our mission, which is to work in support of and alongside U.S. industry to support the development of quality infrastructure in Nigeria and around the world in developing and middle-income countries.
Yeah, because when you look at the U.S. and Nigerian partnership and relationship, it kind of go quite a long way. And I'm looking at that now. We've seen initiatives like the Prosper Africa initiative. We've also seen the PGI come on board, which is the Partnership for Global Infrastructure Investment. And looking at these engagements between the U.S. and Africa, I'd like you to speak to what else, how you see that evolving going forward.
Well, it's really very reflective of the strength of the partnership and the longevity of it. And it's one, and certainly President Biden and our administration has really focused on the equality of the partnership. And for us, it is fundamental. And you'll see that theme in the Partnership for Global Infrastructure and Investment. You'll see that in the U.S. strategy towards Africa, where we are focused, most importantly, on working together and collaborating, not just on specific narrow issues, but on global issues of global importance. And certainly there are many of them in the world today. So that's the overall framework. And then for an agency like USTDA that really focuses on infrastructure development, these initiatives like the Partnership for Global Infrastructure and Investment provide the framework for then the work that we continue to do. The goal of PGII, as that is known, is to really stand up game-changing infrastructure projects that are going to have impact. And, you know, the United States intends to do that in partnership with G7 countries. And it is in the very sectors that USTDA focuses on, such as climate and clean energy, healthcare infrastructure, digital infrastructure. And so there's a very natural sort of partnership that then we can, in a very practical way, implement on the ground, which this visit certainly is helping me to do.
Yeah, because I'd like to take you back to the strategy towards Africa, and more or less why it's important to have that shared priority in terms of making sure the outcomes that we both desire as nations come to pass.
I think it's really important because in the end, you're only going to achieve your goals, be able to implement your strategies and, you know, build infrastructure if you're doing so with a shared understanding and a commonality of view, if you have a context of mutual benefit and our collective prosperity. And I think it's important to state these things very clearly so that there's no mistaking our intent. It's very clear, and so when we come to work together, the foundation is set. For us as an agency to know that you know, economic recovery is key in the strategy towards Africa is a natural pathway then to focus on the thing that enables economic recovery, which is infrastructure. So it's all linked together, and when we look at the sectors that, as I mentioned, we focus on, that can flow up to the results given the framework that is set.
Meanwhile, in Ghana, the Ministry of Energy has commenced talks with the National Petroleum Association, the Ministry of Finance and the Bank of Ghana to find solutions to the rising cost of energy as Ghanaians feel the pinch of higher energy prices, which has spiked well over 10% so far. We spoke to John Gachi, the Dean of University of Cape Coast School of Business, to assess the impact of these hikes.
Well, it's a serious concern because energy prices are very sensitive to economic activities such as transportation, and its effect on food prices because of distribution effect. So there is the call in the country for something to be done so quickly to deal with the rising prices in energy. The situation is hoodwinked from two perspectives. One, because of the value of the currency, which is not strong, and increase in crude oil prices internationally. All these things aggravate the situation for Ghana. And in fact, there is also concern that if we are not careful, within a very short period of time, we may not be able to have a refined product at the filling station for consumers to buy and to go about their economic activity. So it's a serious concern that have been raised, and we hope that the Bank of Ghana and the government of Ghana will be able to raise the necessary amount needed to be able to provide foreign currency needs of those in the energy sector.
How much of an optimism would you say you have at this point in time, especially from these talks that will hold soon? This wouldn't be the first time we're having rate hikes in terms of energy prices.
Well, I think the challenge is that they have been having talks, but the Bank of Ghana has not been in position to meet all their dollar demands because of dwindling reserves that the Bank of Ghana faces, and the closure of the international capital market to Ghana, and general economic challenges that the economy is going through. So I'm not too sure that they will be able to meet them per their expectation. Perhaps they may do some few things to calm the situation, but it is really, really precarious, and one cannot be too sure that the dollar needs will be met.
And talking about how precarious the situation is, we are dealing with low minimum wage at this point in time. We are dealing with workers not necessarily seeing any improvement in their salaries as well. But as we are also prepping for the next inflation report and what's going to come next, how do you see this also exacerbating the pressure that the Ghanaian economy will have to face? We're having talks around the $3 billion IMF loan agreement, looking at debt sustainability issues. How do you see all of this mix playing out? At the end of the day, it's difficult for the government to steer through all of these issues, wouldn't you say?
Well, I think for the first time, you hear commuters in support with any increase in transport fares because they believe that the depreciation of the cedi has made the cost of importation of spare parts and the cost of fuel very expensive for vehicles. So for the first time, the commuters are on the side of transport owners. And of course, increase in fuel being very sensitive kickstart a new phase of increase in the level of prices and, for that matter, inflation. So one is actually expecting that the pass-through effect of these new measures that have been taken will culminate in increase in the level of inflation. As to whether it's going to be marginal or very wild increase in inflation as we saw in the last window, one cannot tell, but we can be very certain that inflation will go up again. It is also very clear that there is confusion right now because we do not know the debt sustainability issues that are being discussed, especially discussing debt restructuring. The government is not coming forward to make things very clear to the people, to the extent that many people feel that their investment in treasury bill and some government bonds may be affected, and the banks are complaining that a lot of customers who have invested in treasury bills are coming for discount. Okay. And I think the government need to calm the market by coming with a very clear and information that the investors within this space can associate with.
And this brings us to the end of Africa Business Weekly for this week. A big thanks to Palesa and Tessie for the regional updates there. I'm David Alabi, and we'll be back same time next week for more weekly updates and business stories across sub-Saharan Africa. Many thanks for watching so far.